I would now like to invite Mr. Nikhil Chopra to begin the proceedings of the call. Over to you, sir.
Thank you, Jason, and good afternoon, everyone. A warm welcome and thank you for taking time to join us for this discussion on the operating and financial performance of JB Chemicals and Pharmaceuticals Limited for Q3 FY22. I will start with an overview of our performance during the quarter and share our perspective on the business, following which Lakshya Kataria, our CFO, will take you through the key financial highlights. Then we'll be happy to take all your questions. We believe that our performance in third quarter reflects a strong business momentum in macroeconomic environment that has continued to be challenging. Revenue growth in India saw positive traction from our renewed go-to-market model and new product introductions. This resulted in JB becoming the fastest growing company among the top 30 in the industry in current year 2021 as per IQVIA Med December 21. Further, major parts of our international business, including CMO business, witnessed a gradual demand revival. During Q3 FY22, revenues on a reported basis have expanded by 10% year-on-year to rupees 601 crore and by 19% to rupees 1800 crore in the 9-month ended 31st December 2021. Here it is important to highlight that excluding the revenue which got deferred in Q3 FY21 from Q2 FY21 in the previous financial year, our revenue growth for Q3 FY22 was 23%. So at an organization level, the positive business momentum was maintained during the reported quarter as well. Coming to our domestic formulation business, as per IQVIA data, JB was the fastest growing company among the top 30 companies for the calendar year 2021. This was in continuation of our ongoing sector outperformance. As per December 2021, JB Chemical grew at 27% versus market growth of 18%. For Q3 FY22, we grew at 27% versus market growth of 10% as our realigned go-to-market model continued to deliver positive results. Also, it would be pertinent to highlight that our growth is sustainable given that the contribution from our COVID portfolio is insignificant for the India business. Our new product introductions are performing well in the market, and this is reflected from the fact that new product contribution is now close to 4.2% to our domestic sales in Q3 FY22 and 4% for 9 months FY22. These initiatives have been backed up by implementing go-to-market model that has repurposed existing resources in an efficient manner via initiatives such as Salesforce automation, Salesforce excellence, greater digital adoption, hybrid digital strategies expanded through geographical coverage. Also, entry into new therapeutic segments have accelerated the new product introduction. During Q3, the domestic formulation business launched approximately new products including Molnupiravir, Cilacar TM, Azovas T. These initiatives may gather further pace after the recent announcement acquisition of brands and related assets from Trendlyne Private Limited in the area of probiotic, therapeutic nutraceuticals and reproductive health market. As you know, Trendlyne is a leading player in probiotics and hormone segments with a portfolio of brands that includes Sporolac, Loban, Gynogen, Pubergen and Nanoleo. Post this acquisition, we are among the top 5 probiotic players with additional synergies across a strong prescriber base in gastroenterology and nephrology segments. In addition to this, we have also entered into IVF segment. We will also derive leverage from JB coverage and reach into states like West Bengal, UP, Bihar, Kerala, where overall the Trendlyne presence is negligible. Overall, we expect to jump 2 ranks in our IPM ranking as we start reporting combined numbers. Coming to our international business, we witnessed steady revival across geographies except for muted demand in US generic business. South Africa, our home market, continues to record in both public and private market by leveraging retail pharmacy relationship and our access in both in-house as well as third-party products. In Russia and CIS region, we delivered strong growth within our prescription branded generic portfolio during third quarter. In the CMO business, where we address both pharma and consumer sectors through our presence in lozenges, JB performed well due to demand revival in key markets. Our API business run rate has also improved significantly versus quarterly run rate as seen in H1 of the current year. Overall, supply chain disruptions impacted the business during quarter 3 as well as freight cost increased significantly for all key markets. However, with COVID situation normalizing, we are seeing strong signals of demand revival, especially in our CMO segments for our international business. We now see multiple levers for our continued outperformance. This includes leveraging our existing go-to-market model strength in India business, maximizing new product introduction, lifecycle management opportunities, and strengthening our international market through portfolio augmentation. All these initiatives should translate into enhanced long-term value for our stakeholders. Going ahead, we continue to remain upbeat about the domestic formulation business. The successful implementation of go-to-market model, new product introductions, lifecycle management of our big brands, and Sanzyme portfolio acquisition will enable us to continue to record market-beating growth for the business. Post-COVID, our international market should bounce back, which we are seeing early signs of revival. We also see medicated lozenges segment picking up as the order book from our global customers have gathered momentum. Our focus will continue to drive faster top-line growth with healthy EBITDA margins, which will enable us to create further value for our shareholders. On this note, I conclude my opening remarks. I would now request Lakshay to share with you a brief perspective on our financial performance. Over to you, Lakshay.
Thank you, Nikhil, and a very good afternoon to all of you, and welcome to our Q3FY22 earnings call. I will now take you through some of our key highlights during the quarter. So overall, during Q3, we recorded a revenue growth of 10% at INR 601 crores, and for 9 months at INR 1800 crores with a growth of 19% year on year. As mentioned earlier, the underlying revenue growth is 23% due to revenue deferral from Q2 to Q3 FY21 in the previous financial year. Our strong revenue momentum continues for the overall business, and both domestic and international business saw double-digit revenue growth during the quarter. Domestic formulation revenue was up by 20%, led by large brands and market-beating performance in non-COVID therapies. In the 9 months, domestic formulations grew 32%. Going forward, with the acquisition of Sanzyme brands, we expect domestic formulations to contribute more than half of company's turnover. International business reported a revenue of 315 crores during the quarter, which was up 3% due to high base last year, as explained earlier. Within this, the export formulation business revenue came in at 241 crores, CMO at 50 crores, and API at 24 crores. Within formulations, there was a positive growth contribution from both Russia and South Africa. Our gross margin profile during the quarter remained steady at 66%. But there was a significant inflation witnessed in API and packing material cost across the industry. We managed to maintain gross margin through cost optimization initiatives and judicious price increases. Our major fixed operating costs are now running at normalized levels. We have now completed our build-out of the organization, and thus employee benefit expenses, excluding the non-cash ESOP charges, have increased marginally. Other expenditure witnessed sharp increase during the quarter on a year-on-year basis because of significant escalation in logistics and freight cost, as well as substantial increase in power and fuel cost. This trend, I believe, stands out not just for JB, but also for our peers in the pharma sector. Despite the sharp surge in expenses, we largely maintained our operating EBITDA margins. excluding non-cash ESOP cost at 25.5% for the third quarter, with the operating EBITDA of 153 crores, similar to the previous quarter. While operating EBITDA seems to have declined year-on-year from 171 crores to 153 crores, after adjusting for the base impact due to revenue deferral, the operating EBITDA has grown by 7 to 8% on a year-on-year basis. While cost pressures are expected to remain in the short term, in the medium to long term, any future benefits and normalization of material and packaging costs will allow us to improve our margin profile or provide adequate opportunities to invest in growth opportunities with similar margins going forward. Also, as fixed cost overheads are now stable, we can expect other expenditure to provide further room for operating leverage in the medium to long term. Other income during the quarter was significantly lower on a year-on-year basis due to treasury yields being lower in quarter three and a one-off income of 34 crores in the previous year on account of sale of certain trademarks. As you know, JB's acquisition of Sanzyme brands, we have invested our cash resources on our balance sheet. We paid the consideration for the transaction in the first week of February. This is a part of our strategy to expand our footprint in India and will serve us financially well as we grow the Sanzyme portfolio profitably, especially in this volatile financial environment. I would also like to take a moment to explain the overall PAT development for the quarter. Sequentially, the PAT softened from 98 crores to 84 crores due to treasury yields softening. The year-on-year decline from INR 154 crores to 84 crores in PAT can be explained by three large factors. A non-cash ESOP expense of 25 crores during the quarter, trademark sale of INR 34 crores in the previous year, and the revenue deferral impact in the prior year base. Going forward, we expect the business to expand by leveraging the existing base of manufacturing, distribution, and relationships. The larger ecosystem available from Sanzyme will provide further cross-leverage opportunities. Overall, we remain focused in our pursuit of profitable growth, strong cash flow generation, and creating ongoing stakeholder value. With this, I conclude my opening remarks. We would now like to open this forum for an interactive session with all of you, and we'll be happy to respond to the questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who would like to ask a question, please press star and 1 at this time. The first question is from the line of Abdul Kader Puranwala from Elara Capital. Please go ahead.
Hi. Thank you for the opportunity. So would it be possible to provide the India growth breakup into price, volume, and new launches?
Lakshay, would you like to take this?
Yeah. So overall, like Nikhil alluded to, the India growth has a component of 4%, roughly, that came to new products. And at the overall level, we, YTD have seen a growth of about 30%. And between price and volume, price would be closer to about 10% and rest would be volume.
Got it. And my second question is on the margin side. So, if we adjust for the ESOP charge, then the margins would be somewhere around 23 to 24%. So ahead, what is the kind of margin should we look for whether this 23-24% would sustain, or you think, the business can go up to 25% on a EBITDA level?
Yeah. So let me first just clarify the operating EBITDA for this quarter. Operating EBITDA for this quarter before the ESOP charge is 153 crores. What you see as reported EBITDA of 128 crores includes ESOP charge of 25 crores. So if you adjust for that, our EBITDA for this quarter is roughly 25.5%. And like we have guided in the past, I think we would maintain close to our run rate of operating EBITDA. Hope that answers your question.
Sure. Thank you. I'll get back in the queue.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Naresh Vaswani from Samiksha Capital. Please go ahead.
Yeah, my first question is on the India business. So last time you had mentioned that we are looking at around 100 crores of normal run rate now. So this quarter we have done slightly lower, around 278 crores, despite our new products contributing substantially around 4.2%. And also, if I'm not wrong, you have taken Rantac price hike in December. So that should have added on top of that normalized run rate of 300 crores. So can you explain where the volume was bit lower?
So, Naresh, this is Nikhil Chopra here. So, Q3 was a soft quarter for India because of the lean season for Rantac and Metrogyl that are our big brands. But you are right that our run rate is close to 100 crores. And going ahead, we see the trajectory close to 100 crores and above in the coming time with new products contributing, and eventually the Rantac price increase will take in.
So this Rantac price should start reflecting fully from Q4, right?
Yeah, some part has been absorbed for Q3 and we'll have Q4 benefit also.
Okay, and second, on the international, this year has been a bit soft due to higher inventory in some geographies and logistical issues. But for FY23, how are we placed in terms of growth in different geographies, if you can explain?
So what I shared in my earlier commentary, that when we see the order book for Q4 and Q1, which I can talk right now, we are seeing demands bouncing back in our branded generic market. CMO business is seeing a big revival, and equally Russia and South Africa, which are our next to home markets, have also performed well in Q3 and Q4, Q1 also. We look forward for the same performance. So our run rate for international business, which now we have bounced back 300 crore plus, should see a positive momentum going ahead.
And in terms of price increases which you have taken, so have you considered the increase in overhead cost as well, the freight and the fuel power cost?
Akshay, would you like to take this?
Yeah. So overall, I think from a pricing perspective, we are now in conversations with a lot of our customers in the international markets. And the conversation really is around the points you made, which is that the freight and the fuel cost have risen significantly. And also, on the API and packing material part, there is a significant inflation. So pricing will continue to be a key focus area for our international businesses as we move forward.
Okay, I'll join back in the queue.
Thank you. The next question is from the line of Vishal Manchanda from Nirmal Bang Institutional Equities. Please go ahead.
Thanks for the opportunity. So just a clarification on Rantac. So what percentage of Rantac sales during the quarter would have come from higher prices?
So around 60% plus sale would have come from the price increase. But equally, Vishal, what you have to understand also, with the entire cost of API, foil, packaging material going up, conceptually this is just helping us to maintain the right EBITDA margin overall for the company.
Okay. API cost has also gone up during the quarter, and not only for Rantac but across the board, basically.
Yes.
Okay. And so second on the lozenges business, can you kind of share some color on any developments there in terms of new contracts or new product development? which is basically going to help you in the near term?
So there are a couple of things which have been happening in the world of CMO business, particularly lozenges, which we shared in our last conference call, that we have added Reckitt as a new partner who has come in. And equally, the good sign is that across the CMO business, we are seeing a big demand bouncing back. So that is a positive sign. We are working on some new novel concepts in the world of lozenges, which are more consumer friendly, and those novel concepts includes products like melatonin, products which we are developing for the world of immunity plus cough and cold. So all those portfolios are on the anvil where developmental work has been happening. So going ahead, the strategy would be how we offer novel therapeutic portfolio to our existing partner, be it for P&G, J&J, Innova, Reckitt, and equally add more partners where the entire business development work is on.
Okay. Sir, on the new client addition, Reckitt, has that started delivering, or it will scale up in time?
It has started. Just a couple of products we have started supplying to Reckitt, but overall we should see a good demand in the next financial year.
Understood. Sir, other expenses, would they stay at current levels, and ESOP expenses also around the same level for the coming quarters?
So ESOP expenses would be close to what Lakshya spoke about, would be close to 25 crores. And other expenses, when Lakshya gave the commentary in terms of the entire capability development that we have put in place, have normalized. Cost of goods, still conceptually we don't know what is coming in next couple of quarters, but overall from an operation perspective, our costs are close to normal.
Understood. And just one final one on some comments on your initiatives on the nephrology front. So how is that shaping up in terms as a portfolio, nephrology portfolio?
So nephrology portfolio, we have a niche division which has been working with 2,000 nephrologists in the country. Those are all the portfolio is a mix of our supportive products. But what we are trying to do with nephrology as a specialty, because nephrologists are a big supporter for our brands like Cilacar and Nicardia, where we continue to engage with them and continue to look at in terms of how we can build these brands bigger, and equally how do we support this specialty in a supportive care portfolio where our team of 30 people is going and working with them. So, but there's a good uptake in terms of the new products that we have launched, but all those has its own gestation period. 6 months we have been in the market with our new products, which is half a dozen products that we have got in the supportive care therapy. But the bigger picture that we want to paint is how do we take Nicardia and Cilacar to next level.
Sir, is dapagliflozin also getting a share from the nephrologist?
Dapagliflozin is more being detailed in the clinic of MD medicine, cardiologist, and diabetologist. And dapagliflozin, just to share with you, we were the 60th company to launch dapagliflozin. Today we are in top 15. Our run rate is close to around 75 lakhs per month, and we intend in next quarter, 3 to 4 months, we should be in top 10.
Just to add,
yes.
Just to add, for nephrology with Sanzyme acquisition, we have a lot of cross leverageability opportunity also in the field of probiotics. So that's also part of our plan.
Yeah.
Right, sir. Yeah. Thank you. That's all from my side.
Thank you. The next question is from the line of Rahul Jivani from IIFL Securities Limited. Please go ahead.
Hope I am audible.
Yes, Rahul.
Yeah, thank you for taking my question, sir. Just a few clarifications. So you said that Rantac price hike contributed during the quarter. So for what quantum of duration we saw the benefit on account of Rantac during the quarter? Would it have been a month?
Kunal, you would like to take this?
Yeah. So Rahul, substantial part, just over a month, close to 45 days of demand for Q3 was serviced through Rantac. However, from a pure volume perspective, when we look at it, right, we had earlier also mentioned that the demand would moderate in H2 because the Q1 run rate had seen a huge surge due to second wave of COVID. So surely from a volume standpoint, the demand moderated and operated at a steady state scenario in Q3, but close to 40 to 45 days of sale for Q3 was attributed with the price increase.
Sure, sir. And now if we look at our India portfolio growth for next year, our base India business has been growing at mid-teens. On Rantac, we will have the full year contribution next year as well as the Sanzyme portfolio contributing. So how should we look at your India business growth for FY23? So do you think that the momentum which we had in FY22 that will be sustained in FY23 as well?
So Rahul, if you look at the way we are positioned, overall there are 3-4 hypotheses when we look at India business. First hypothesis is 70% of our business is coming from big brands, that is Cilacar, Nicardia, Rantac and Metrogyl, which the teams have been working on how do we make the big brands bigger and continue to gain market share. So that is agenda number one because that is a big chunk of our business. Second, obviously what you are talking about Rantac price increase, that should give us benefit. And thirdly, of course, with the transition happening of Sanzyme portfolio, all this coming together, the guidance that we would like to give at this moment of time that we will be delivering market-beating growth with a significant difference. And overall, look at in terms of how with the widened portfolio that we have got with big brands, with new productions, and with the Sanzyme portfolio, how we can serve more and more number of patients and deliver market-beating performance.
Sure, sir. So this market-beating outperformance will be excluding the Sanzyme portfolio. So contribution from Sanzyme will be on top of that.
Yes.
Sure, sir. And in terms of this Rantac price hike benefit for next year, you have stated that the API has also seen a price increase, and our earlier expectation was that on Rantac we could see a margin benefit playing out for us. So do you think that thesis still holds that the price increase for Rantac will help us to improve our margins in FY23?
Kunal, you would like to take this?
Yeah. So Rahul, what we have seen over the last 3 to 4 months, there has been a significant price escalation in ranitidine API cost, right? Starting Q3 onwards, which to a large extent has neutralized the actual margin benefit which we would have otherwise got through price increase. Our focus will be to continue on maximizing the price hike benefit, but at this stage all we can maintain is that a significant chunk of margin benefit which was to accrue has to an extent got neutralized because of the ranitidine API price hike.
Sure, sir. But are you expecting the API prices to moderate? Because generally the commentary across the industry is with conclusion of Winter Olympics in China by end of Feb, the API prices should start moderating. So do you think that if API prices moderate, we can then see this benefit on Rantac price hike next year?
What we are certainly hoping is that the prices don't go from the current levels. There are certain product commodities where the normalization will be much more rapid, and it's a classic demand and supply situation. With respect to ranitidine, there are not many suppliers, so the supply base tends to be limited. What we are very sure of that we should be able to hold on to the current price levels from a midterm perspective.
Sure, sir. Just one last question before I join back the queue. Although it has been still early days, 2 weeks only since you closed the Sanzyme acquisition, but any thoughts in terms of how the integration for the portfolio is progressing and what you have seen in terms of your initial interactions with the MRs or doctors as far as your Sanzyme portfolio is concerned? Thank you.
We are very hopeful and positive about integration giving us good results. The last 2 weeks, there have been a lot of cross synergies which have kind of come up. We are happy to report that the business is going as smooth as it was before our acquisition. our key endeavor is to ensure that there is no disruption at this stage. From our future strategy standpoint, we are certainly seeing prescriber synergies, as Nikhil mentioned, with respect to nephrologists, the MD physicians, where we believe probiotic could be a big opportunity for us. We see geography synergies because 3 to 4 states where they have negligible presence are also our pockets of strength. And we see product synergies. For example, probiotic, which is Sporlac, is extensively prescribed as a co-prescription with our metronidazole. So there are a lot of things, which we have to kind of bring it together. And so far, the response has been very, positive.
Sure, sir. Thank you. That's it from my side.
Thank you. The next question is from the line of Amit Kadam from Canara Robeco. Please go ahead.
Yeah, hi. So I have a couple of questions, sir. So starting with maybe just wanted to know because Russia is a key market and the thing geopolitically whatever is, or maybe what we are seeing it, what's your take and what's our risk mitigation strategy there? So that's question number one. Second, I just wanted to know, pick your mind on this particular your CDMO, where in medium term you want to grow this particular business with change of management and in senior management also and on the promoter side also. How do you see this thing shaping up maybe from a 3 to 5 year bucket? And my third, I just wanted more clarity that couldn't get the clear on the ESOP thing. How much charge off is yet to happen every quarter? And maybe just wanted to know what will the per quarter charge off for maybe till this completely goes off.
So let me take on the question of the ESOP and
Okay.
then we go to the Russia question. So as far as ESOP is concerned, we are basically, we expended out 25 crores, in the last quarter. Prior to that, our expense was about 13 crores. Right. Overall for the fiscal, it'll be about closer to 63 crores, right? That's as far as this fiscal is concerned. Next year, the fiscal will have a spend of about 68 odd crores. And then it starts tapering off significantly.
Sorry, I did not get it. FY23, how much?
FY23 will be about 68 odd crores.
Okay.
And then it will start tapering off significantly.
Okay, fair enough. And then my balance question.
Kunal, you would like to take the question on Russia and CDMO?
Yeah. So with respect to Russia, we are closely monitoring the situation. It's uncertain and slightly volatile. However, we need to look at what are the variables under our control. So over the last 1 month, we have been extremely watchful and mindful of our supplies to the Russia and CIS market and trying to do everything we can to ensure business continuity remains. And the other thing which we are extremely watchful of is the receivable situation. So these are the 2 areas where we have put in a very high level of check mechanisms. We do believe that the situation is relatively better than what the outlook was a couple of weeks back, but it's wait and watch as of now. All we can do is be much more cautious about our overall receivable situation and also ensure that there is no real loss from a business continuity standpoint. With respect to the second part of your question, which is CMO, this is one business segment where we continue to be extremely optimistic. In fact, from if one really looks at the sequential trending of this business over the last 9 months, we have seen the demand reviving back in our key pockets and with our major customers. Our CMO strategy is certainly going to be twofold. One is expanding the basket of products and offerings which we have to our current main anchor clients. So our main anchor clients, including big names like P&G, J&J, Inova, we have been closely working with them on introducing new concepts like Nikhil mentioned, immunity booster concepts, immunity with cough and cold, different finished dosage formulations for actives like melatonin. These are certainly kind of areas which we are closely working and are in the product development life cycle right now. And the second part is add more anchor clients and increase our presence with the current clients in other geographies. So addition has already started. You heard of Nikhil mentioning RB. We had our first shipment to them in the last month of Q3. We are certainly expecting good ramp up from them for the next financial year. And what we really want to do is add a couple of more marquee clients, which are in the same league as these 3-4 names which we mentioned. So there'll be a lot of thrust on accelerating business development initiatives to grow our CMO business, and we continue to be optimistic about this from a mid and long-term perspective.
I understand, but just wanted to know more on like a little granularity. For example, if we want to shape this particular business, right now we are maybe doing like 200 to 250 odd crore thereabout. So if we have some objective in mind, so because this will require a front ending of kind of an investment, be it like ramping up the R&D people or maybe the facilities to so that that's how the body shopping or that would happen to our clients. So just wanted to know how that will also happen, like in terms of investment, and then how do we translate that in your future numbers?
See, there are two parts from managing the infrastructure and the resourcing part of it. The good thing is that we are already covered from an infrastructure standpoint. So our current capacity utilization is close to 60%. We have one line which is pretty much can be activated and made operational if our business ramps up. So there is no real huge capex investment which we see in the business. From an R&D standpoint, whatever needs to be done has already been activated. Over the last 7-8 months, as Nikhil mentioned earlier, also that R&D reorientation and with the focus being on CMO related projects was closely monitored, and we are at a stage where we have advanced concepts of all these offerings being taken to our clients. So the R&D reorientation and ramp up has also happened. The third area is where they have to be thrust on BD acceleration, and that's what we are really working on. So, if the external concern is more from an investment related to infrastructure or resources, that is already being taken care of.
Okay. Thanks. Yeah, I'm done.
Thank you. The next question is from the line of Alok Dalal from CLSA. Please go ahead.
Hi, good afternoon. So one question on the US market. What is the current sales in US at the moment?
Kunal, you would like to take this?
Yeah. So we don't want to really give clear numbers of our international business segments. For us, Q3 was slightly soft, but as our order book stands right now, we see the demand picking up to the H1 levels of FY23.
And Kunal, what is the outlook for the US? How do you see the US expanding over the next few years? What kind of products are you working on?
So we have always maintained that we'll have a very selective approach, towards our US business. We have an aspiration of looking at 3 to 4 filings every year, and a lot of our R&D efforts were focused towards that. But these are offerings where we believe our strength really lies. So we are not talking about getting into specialty or complex generics. Our strengths are more on large-scale manufacturing in platforms such as Oros platform, and we want to continue to play to those strengths. Our focus will be ensure selective ramp-up, 3 to 4 filings per year, which would add to our US kitty, have a very stage-gate approach. And as we see success, we do ramp up accordingly. That's the way we want to play to our US business.
Okay, thanks. And on the international markets, any plans to expand operations outside Russia and South Africa?
So, Alok, this is Nikhil here. So, outside India, Russia and South Africa are home markets. And if you look at the entire ROW business is in 4 clusters. That is Sub-Saharan Africa, Middle East, Latin America, and Southeast Asia. So those are the markets that we are present. outside India. Now, the way we are looking at this international market, which is ROW, branded generics, Russia and South Africa, is not to go wide but to go deep. And all these markets have been deprived with the new portfolio. So the management has been working in terms of how do we get new products introduced in these markets and how do we go deep, because the relationship that we enjoy in ROW market with some of the big distributors who work for us is immense. So there's an immense scope in terms of what we want to do with introduction of new portfolio. And equally for South Africa and Russia, Russia this year we have introduced 3 new products. South Africa, there are some dossiers which we had bought where we are looking at how do we launch those products in private markets. So that is a play that we want to work on. So we don't want to get into any new markets, but equally we want to look at that how do we go deep and at least get the better output with existing portfolio and new introductions.
Okay. So, but Nikhil, will the idea be to keep it 50-50 between domestic and export?
Eventually, along with the Sanzyme acquisition that we have done, India business would be 55, ROW would be close to 45. Going ahead, the way we have engine running in India business, we are looking at how do we at least get India business close to 60% and international market close to 40%. That is the aspiration we have kept. Now overall we'll see in the coming time how it helps. And within India business, Alok, we are looking at how do we have a better chronic play. That is the intention.
Okay, understood. And just one last question. The pressure on gross margins, how should one think about it, especially in the coming few quarters?
Rakshay, would you like to take this?
I'll take that. Thank you. So from a gross margin perspective, I think if you look at what's happened till now, I think we've sort of held fort pretty well, with some of the interventions we've done in terms of long range contracts and, certain inventory interventions. But our reading right now is that, costs have seen a further sort of scale up, post-December. So I think at the current sort of level of gross margins of 65, 66 is where we would want to hold. And we would want to sort of, we will have to work still significantly on our pricing lever and also on some of the COGS optimization projects that we are running internally to maintain that level. Otherwise, I think from an inflation perspective right now, I think there is still more pain to sort of come.
Okay, understood. Okay, thank you very much for taking my questions.
Thank you, Alok.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question at this time. The next question is from the line of Sonal Gupta from L&T Mutual Fund. Please go ahead.
Yeah, hi, good afternoon, and thanks for taking my question. So just on, the other expenses, right? Last quarter, you had about 14 crores of one-time consultancy charges. But even as those have dropped off, we haven't seen that much of a decline. I know you called out freight, etc. So could you just talk about that as to, incrementally, what has been the pressure point sequentially?
Yeah. I'll tell you. So basically, if you see quarter on quarter, our expenses have jumped up by about 7 crores, excluding manpower. And like you rightly said, if you square off the 13, 14 crore one-off, then we are still seeing an increase of 6-7 crores, which is primarily happened in 2 lines of our P&L. One is freight, and the other is power and fuel. Both on natural gas prices and on the freight side, we've seen further hardening towards November and December. So that's what sort of explains the operating expense quarter on quarter.
And like you mentioned to the previous answer, so you're still seeing this like on a full quarter basis. There could be more pressure in Q4 on this side.
While there is pressure, we are hearing that, some of the electricity boards, etc., are putting, plans to take up the power tariffs. So I think it's a sort of ongoing situation. But we are also working on, steps to mitigate that, right? So we are also looking at steps to mitigate our utility cost, our footprint. We're getting into solar. So, there are mitigation plans also. So maybe one odd quarter here and there, but we should try and hold to, the fixed operating cost.
Got it. And how much of your portfolio in India by value would be under NLEM?
Around 30%.
And so just given that we've got Rantac increase, would we be eligible for taking an increase in April again, or will not?
Yeah, we'll be taking the price increase whenever it comes on the existing portfolio, which is outside price control, and whatever WPI comes for the control products, we'll be taking that price increase.
Right. No, so I'm just trying to understand, given that Rantac is a big part of that NLEM portfolio as well, so will you be allowed to take another WPI related increase, or that?
Yes.
So you can take on the full 30% of your portfolio?
Yes.
Got it. Yeah. Thank you.
Thank you. The next question is from the line of Kunal Mehta from Vallum India. Please go ahead.
Thank you very much for the opportunity. I had a simple question. I wanted to understand your perspective on the long-term, growth process of cilnidipine. The underlying molecule for Cilacar. So, wanted to understand firstly, as we see more SGLT drugs, going off patent. So, do you see the long-term growth of this, molecule shrinking to some extent, and the share being, taken off by SGLT2? Because when I look at the data on trials, a lot of the trials are actually, giving positive data on the ability of the SGLT2 class molecules to, give protection to hypertension patients with kidney, associated kidney problems. So, any view on this would be helpful.
Kunal, you take this?
Yeah. So, Kunal, SGLT2 is a very, very different class of molecule. Our cilnidipine franchise is a calcium channel blocker. SGLT2 molecule is, the line of treatment for diabetes patients. Now, there are studies which really indicate that, there are certainly some benefits associated for SGLT2 molecule as a class, either with respect to heart failure or management of better renal complications. But that does not mean that it becomes the first or second line of therapy for antihypertensive treatment. That's point number one. Second thing is, when you really look at the SGLT2 class, it's not a therapy which may be recommended for all age groups or, all types of demographics, who may be have a very different clinical profile. We certainly do not see any real primary conflict with SGLT2 as a class. It's a very different class where diabetes is the primary indication. For us, what we really want to work on is cilnidipine being the most preferred choice of antihypertensive drug class, which will be prescribed for comorbidity issues, including primary renal, complications. So that's how we see, and we have seen a lot of confidence, coming in from prescriber categories such as nephrologists, diabetologists, cardiologists, and physicians. And we really see no reason why this continued faith in this category of molecule, which is cilnidipine, will not continue over the mid and long term.
Sure. So just a follow up on this one. So if we have to attribute, let's say, three crucial reasons for why this molecule has done so well, as compared to the other molecules in the CVS space, associated CVS space in the last 3-4 years, or 5 years, I would say, it's grown in high double-digit in volumes. So the molecule as a whole. So could you give me three reasons in this, which has worked in favor of cilnidipine? One, yeah.
The most primary reason why CCB sees a lot of acceptance is because, apart from being a very effective standalone, antihypertensive class of drug as a calcium channel blocker, it has a very soft side effect profile, and patients who suffer from comorbid indications or have complications more on the renal side, they see very limited side effect profile. In India, what tends to happen is most of the times, patients, when they approach a doctor, they are in stage 2, stage 3 of, antihypertensive, with already these comorbid conditions being, developed with respect to the clinical profile. So doctors are very particular about the medication which they are prescribing, and they should not have any further side effects on various other parts of the organ. And that's where cilnidipine has seen a very, very strong acceptance.
Got it. Thank you very much, Mr. Thank you.
Thank you. The next question is from the line of Cinderella Carvalho from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. Just continuing brand-related discussion, just want to understand the recent brand extensions that we have launched for our bigger brands. What kind of potential do you see for them? Can they become as big as our larger franchisee? Is there that kind of market pickup, market share gain that you're seeing, or preference from doctors that you are seeing on the prescription level? Anything that you can highlight on that?
So Cinderella, this is Nikhil Chopra here. Overall, the intention, JB historically has never been that great in new product launches. So what I shared in my earlier commentary, that the new product introduction value is now close to 4%. That itself is a big achievement, and going ahead, we are looking forward at how this can at least come close to 6 to 7% in the coming time. Overall, when we look at new product introduction, it is a mix of two categories. One is life cycle management, as you earlier shared. So obviously we have Cilacar T, and now we have got Cilacar TM that eventually helps us. Cilacar being a 300 crore franchisee, in the coming time, in next 2-3 years, we are looking at how overall Cilacar as a family becomes 500 crores. So that is the intention. Secondly, some of the new introduction that we have got into new categories of business, particularly in the world of pediatrics, in the world of respiratory, in the world of antibiotic that we have got into. Out of 12 products that we have launched, we have identified around 5-6 products, which if we are able to make a revenue mark of around 12 to 14 crores in 18 to 24 months, that itself will be a big achievement for JB as a company. Because our 70% of revenue is coming from big brands, and if these new launches also helps overall fueling the growth, this combined entity of existing brands, life cycle management, and getting into new therapeutic area will overall help us, what I earlier shared, in terms of delivering market beating growth. So that is the intention going ahead when we look at new introductions.
This is very, very helpful. Just to add to that, I mean, if I take your commentary in the right direction, what you're trying to tell me is we're very focused on gaining market share in our core brands as well as new launches. I understand this. If I put ourselves today, say, in the domestic market zone, we are still, closer to 1,200 or the secondary market turnover run rate at MAT level. What are the major gaps that you feel, or product-wise, which are the most increasing areas that you might have already identified to take us to, say, 2,000 crore range, and from there around to another next leg of growth? So what are these strategic point of view where you still have some gaps? I understand Enzyme will add some more to this, but from an organic perspective, from a brand perspective, and when do you see reaching there? I'm sure this must be part of your strategy.
So with Enzyme entity being added, Cinderella will be close to 1,400 crores next year. So that is where we stand. 1,200 crore was the current run rate. Now, when we talk of therapeutic areas, we are present in 5-6 therapeutic areas. If I have to talk about cardiology, which we have extended to cardiometabolic with the introduction of dapagliflozin and vildagliptin, that is what we wanted to do. We are a big player in the world of gastroenterology and nephrology, with new products that we have launched in the world of pediatrics and respiratory, and with the Enzyme portfolio coming in, it only adds to or strengthens the area where we are present. See, we want to remain focused. We have close to around 2,000 people on the ground, and with Enzyme 300 people more being added, we see the opportunity in terms of how do we improve the per person productivity, which today stands to around 5.5 lakh rupees per person, and this can easily grow for next 18 to 24 months without adding any feet on the ground at a healthy pace of 12 to 14%. So that is what we want to do. We just don't want to get into new therapeutic areas. We want to strengthen our existing therapeutic areas, and Enzyme acquisition was in that way the step that we took. So the therapeutic areas where we are present and the equity that we enjoy with the healthcare professionals, we want to strengthen that, and we want to do some work which conceptually helps more and more patients who can take medicine from the JB house, and equally develop a good relationship with the healthcare professionals, particularly in the therapeutic areas where we are present.
This helps. There's one more query that I have in mind in terms of our input cost pressure that we are experiencing and the entire industry is experiencing. But say in the followed year in FY23, when we get a chance to take the WPI link inflation for our NLEM portfolio, should the increase take care of our raw material inflation, going ahead? Do you think it should be sufficing to take care of our EBITDA margin sustaining about 26%?
So Cinderella, as earlier also I have guided that last 3 quarters, if you see, we have been delivering 600 crores revenue every quarter. And our EBITDA margins, operating EBITDA margins are close to around 26%. So with the WPI price increase coming in, that should help. And with the pressure that we have on the input cost, we aspire to deliver market-beating growth in the geographies where we are present. We are looking at how do we augment our presence in our international markets by getting new introductions and equally drive operational efficiency within the organization to at least deliver same margin of EBITDA on a market-beating performance in terms of top line. Because fundamentally as a company, we believe in profitable growth. Hello. Great.
Thank you, sir.
Yeah.
Thank you. The next question is from the line of Ankush Agarwal from Search Capital. Please go ahead.
Yeah. Hi, sir. Thank you for taking my question. So firstly, of our initial strategic goal that we presented in March 21, so we have taken steps on the therapy diversification and also augmented our portfolio on the domestic side with the new M&A. Right. So from now on, what would be our strategic priorities going ahead?
So what was stated earlier also is, look at India business with the Sanzyme acquisition, our contribution from India business would be close to 55%. So that is where we stand. We were 32nd ranked company in October 2020. Mid-December, we are with Sanzyme portfolio combined. For the month of December, we are 25th ranked company. That is where we stand, and our intentions are how do we organically and with the Sanzyme acquisition, we want to be in top 20. That is where we stand from an India perspective. So the entire transition and the integration with Sanzyme happening in India business, that is key for us. That is what we had guided earlier also. Second, what I stated earlier was the entire concept of big brands getting bigger. That is what we want to do, and that will happen with closely working with the healthcare professionals and the therapeutic segments where we are present, particularly in the field of cardiology, nephrology, gastroenterology, and respiratory. That will enhance our presence in those therapies where we have introduced new products and the portfolio that we have. That is point number 2. Third, our new introductions have started contributing, which is close to now 4% of our revenue. Going ahead, we are looking at how does it go to 6 to 7%. That is the intention for that is the strategy that we have built on for India business, and all this is backed up by a lot of discipline which is in the system in terms of getting right process and systems in place, getting into the world of Salesforce automation, Salesforce excellence, digital detailing, digital adoption. So all this is backed up when we talk of market beating performance. About international business, what we have guided earlier, the play that we want to have is particularly in our home markets outside India, Russia, South Africa, where we will enhance our presence and go deep by getting new products introduced and look at that how do we leverage the existing setup that we have got. The outside India business, if anything I'm passionate about, is the entire world of CMO, particularly in the world of lozenges. And between me and Kunal, we shared that the entire strategy is looking at how do we get into the new offerings of portfolio and how do we add new partners in this world. So this is where we stand, and at the end of the day, what we are looking at that the run rate that we have got for this year close to 600 crores, how do we maintain that run rate for quarter 4? Look at operating EBITDA close to 26-27%, and there are multiple levers which I have stated earlier, which will overall help us to deliver market-beating performance.
Right. So broadly, it stays the same what we discussed in March 21. Got it. And so, secondly, would it be possible to quantify how much of domestic growth during the quarter was led by Rantac price increase?
So, like we said, overall, from a Rantac perspective, 50% upwards of volumes of Rantac came through, the Rantac, the new price.
Right. But on the domestic growth of 20%, how much of that would be because of the price increase? Because we don't know how much exactly is Rantac's contribution to domestic business, right?
Sorry, we won't be able to share those specifics.
Oh, okay. Got it. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management.
So thanks, Margaret. I think with that, since we have no questions, I think we'll end the earnings call of JB Chemicals and Pharmaceuticals Limited for the third quarter. Thank you everyone for joining us on this.